We're going to talk about several things here. First, we're going to start off with the changes to the flow-throughs. Historically, flow-through entities such as partnerships, S-corps, and sole proprietorships would be reported directly on an individual's tax return. Whatever the net income was or the taxable income is, just reported at 100%. The big change to pass-throughs, and I apologize because I'm supposed to be doing this as well. The big change to pass-throughs is the what they call a QBI deduction. And we'll go through all the different definitions and whatnot, but high level, going forward for years starting 1/1/2018 and ending for years before 1/1/2026, pass-through entities will now receive a potential 20% deduction on the individual's tax return. This is a deduction similar to the itemized deduction. It's going to reduce your taxable income. It's not going to reduce your adjusted gross income. So what is qualified business income? It's really, definitionally, they state it's income gain deduction of losses from a qualified trade or business, which is, not very informative in it by definition, but for the most part, we're looking at it and saying that it's your normal business income with a couple adjustments. So capital gains that are running through the business are carved out of the QBI calculation. The QBI deduction is only allowed for U.S.-based businesses or income trades or businesses that are effectively connected with the U.S. or Puerto Rico. And I stated before, it doesn't include capital gains. Apologize, got to keep up with that. The one thing to note is salaries and guaranteed payments pulled out of S corporations or partnerships are not going to be considered as part of that QBI base where you're allowed a 20% deduction. So the play is trying to maximize and determine what the right salary level or guaranteed payment level is from the flow through, and figure out what the remaining piece is so you're getting that benefit. So as Ray will discuss, the overall individual tax rates are dropping from the highest rate of 39.6 to 37. And with this 20% deduction, your real effective tax rate is around 29.6%. So it's a pretty significant impact. Qualified trades or businesses, the exclusion is if you're in a service business such as, there we go, health, law, accounting, actuarial services, performing arts, consulting, athletics, financial services, and brokerage, you will not be entitled to this QBI deduction. There is an exception we'll get to later that trumps all these rules, but if you fall within one of those categories, you're still picking up 100% of your income. The exception to that's still in the service industry are architects and engineers. They will be allowed to take a QBI deduction. Okay. Determining that 20%. There's a formula that goes along with it. I don't think we need to get into that here. So high level, like I said before, we have to determine what your qualified business income is, take a 20%, and then there's going to be certain limitations to that 20% deduction. The main limitation, and Ray, you got to tell me when I don't change the slides here. The main limitation is 50% of wages. So the easiest example is if you have a trade or business, it's got $1 million worth of wages paid through, not only the owners, but to all the employees. And you have two shareholders of let's call it the S-corp. The individual owners of that S-corp are going to be allocated or deemed to be allocated the $500,000, their respective proportion of the total wages paid. With that $500,000 being allocated, there is going to be 50% limitation, so $250,000 in this example. When you calculate that 20% deduction, if it's below this $250,000, then you get the full amount. If it's above it, you're going to be capped at whatever your 50% of wages are. There is an alternative calculation that is 25% of wages plus 2.5% of the unadjusted basis of qualified property. This is probably going to be really useful for like real estate rental, where there's typically not a lot of salary within the business, but you do have a high value in your building and other qualified property. All right. So qualified property is listed up there. It's tangible property subject to depreciation. So land is not going to be included as part of this 2.5% calculation. It's completely excluded from that. So it has to be depreciable. It does not include intangibles or in that calculation as well. All right. If the flow-through entity is producing a QBI loss, that loss is going to be carried forward to the subsequent years to be offset against the next year's QBI calculation. All right. And as I stated before, there's always exceptions. So the exception to the overall rule with the pass-through QBI deduction is that if a taxpayer has a taxable income, not an adjusted gross income, but has taxable income less than $315,000, the rules with respect to service, the 50% or the 25 plus the 2.5%, all those rules are just, they're not applicable. If somebody's below 315 and you're in a service business, now you still get your 20% deduction. And again, same thing with the 50 and the 25 plus. It's 315 for married filing jointly and 157,500 for single individuals. Okay, that pretty much takes us through the partnership. I have a couple examples, and I believe the decks are being emailed if you guys are interested. But just as an example, I put together a couple slides that show the different limitations on the bottom, one being subject to the standard 20% deduction, the other being limited to the 50% of wages, and then just sort of high level how it would look if it was a real estate entity with, let's say, $1 million worth of unadjusted basis. And the one thing to note with the unadjusted basis is, as we said before, it's unadjusted, so that's before any depreciation. So it's really the original cost or the historical cost. That covers the pass-through changes. Like I said, the biggest change obviously is the change to flow-throughs and how you're potentially getting a 20% deduction on your individual tax return. Okay. Now to move on, we're going to talk about C corporations. So as I'm sure everybody has heard, the big news in C corporations is the rate being reduced from 35%, being the highest corporate tax rate, to a 25% flat tax starting for years beginning 1/1/2018. Next in the C Corp arena is the dividends received deduction. If you had previously in the past, if you had below 20% ownership in another C corporation, there's dividends coming upstream, you would be entitled to a 70% dividends received deduction. That has been reduced under the new code to 50%. The 80% bracket, which was between 20 and 80% ownership, is now being reduced to 65, and for anything over 80%, remains to be a 100% DRD deduction. The next couple of them all, you're going to see the common theme. It all relates to a $25 million threshold. So accounting, cash method of accounting, inventories, and UNICAP are all going to be subject to this new $25 million threshold. So in the past, corporations, businesses that had over $5 million worth of annual sales over 3 years would be forced to switch to an accrual method of accounting. Now, the rule has been up to $25 million, which obviously will bring a lot of people back into determining whether or not going to a cash method of accounting from an accrual basis makes sense for them. A change in accounting method would be required to make that change, but this obviously opens it up to a broader base of companies. Okay, and as stated before, the same rule with respect to the $25 million applies to inventory. If you have a company that's, again, average gross receipts over 3 years, $25 million, under Section 471, you would not be required to account for your inventory. So that means you would be directly expensing your purchases as you acquire them. And then lastly, the UNICAP. So UNICAP requires businesses to look at their G&A costs and determine what piece of that G&A cost is part of the process of acquiring and procuring inventory. That piece would be capitalized into inventory until that product was sold. Same $25 million rule. It no longer is required to go through that sort of lengthy computation to determine what we're going to capitalize to the balance sheet. Okay. Big change, not just to C corporations, but to all businesses. Bonus depreciation, effective September 27, 2017. So this is actually something that you guys can look at for your fourth quarter. If there was property acquired within, after September 27, 2017, bonus depreciation up to 100% can be taken on that property. One of the big changes to bonus depreciation is historically it's been for new property. The new rules apply and state that you can, if it's used, it applies to used property as well. Just for 2017 alone, if you're allowed 100%, but if you chose, you can make an election to only do 50% of bonus depreciation for that year. Okay, Section 179. Section 179, big changes here are the limits in terms of deduction. Historically, well, not historically, but for the past several years, it's been a $500,000 deduction for property acquired with a $2 million limitation. And what that means is if you acquired more than $2 million worth of property in aggregate across all your businesses, it would be a phase out, a dollar for dollar phase out. So if you acquired, too much property, you could ultimately not be entitled to any Section 179 deduction. In the new tax code, you're getting a $1 million tax deduction, and the phase out is bumped to $2.5 million. Okay? So additional depreciation rules. In the past, there's been 3 buckets for qualified property. So qualified leasehold, qualified restaurant, and qualified retail improvements. Each with their own slight little definition and treatment. That has gone away. It's been consolidated into what they're calling a qualified improvement property, and that will be a 15-year life and potentially subject to bonus depreciation as well. All right. Also a change, which is listed on the bottom there, improvements to your own building. As long as you're not expanding the overall building and it's interior improvements, that will qualify as a qualified improvement property subject to 15-year depreciation as well. Increase in the luxury auto deduction. As you can see here, the first year you can take a maximum deduction of $10,000, moving up to $16,000 in year 2, $9,600 in year 3, and then for all years past that, $5,760. One of the other big changes is the interest limitation. Currently, or with the new law, there is going to be a 30% interest limitation on your adjusted taxable income. So adjusted taxable income really is your income without that interest deduction. You determine what that amount is, take 30%, and if your interest is less than that 30%, you're allowed to take the full deduction. If it's greater than that, you'll be capped at your 30%. Anything in excess will be carried forward, and it's carried forward indefinitely. So it's not a permanent loss. There will be, for any companies that are required to do tax accounting, a deferred tax asset would be set up for any of that carry forward that potentially is going to be utilized in the future. And the act is, allows real estate property and trades and businesses to elect ADS, which is an alternative depreciation system, in order to opt out of this 30% limitation. And then I think the last thing we talked about here is that the limitation does not apply to real property development, redevelopment, construction, acquisition, and rental operation, which I think makes sense in the fact that most of those types of businesses are very dependent on financing these type of operations. So especially in the beginning, if it's over leveraged and you're not able to get a deduction, that's obviously not gonna help grow these types of businesses. Last, well, I got 2 more things. So the AMT for corporations has been repealed starting 1/1/2018. However, there's also another change with respect to net operating losses, which sort of puts you back into that AMT realm, and the fact that net operating losses are now limited going forward to an 80% deduction of your taxable income. So there will always be that 20% base of income that's going to be taxed. Okay. The Act also eliminated, previously if you incurred a loss in a year, you would either carry it back or elect to forego that carryback. The 2-year carryback has been eliminated entirely with the new Act. Okay. And last, I think, is the meals and entertainment. So typically, meals and entertainment in the past has been grouped in as one category and subject to 50% disallowance. Going forward, we have to encourage our clients to break out their entertainment and their meals, because now entertainment, taking people to a ball game, and things like that are going to be 100% disallowed going forward. Meals, historically, taking clients and other people out for a meal has historically been 50%. That does remain. The other change would be for meals for the benefit of your employees, I apologize, such as CPA firms buy, dinner for our employees all the time. Those meals, which historically have been 100% deductible, are now 50% deductible going forward in the new act.